Welcome back to the podcast. This episode, we are joined by Mr. John Jeffrey, CEO of Saturn Oil Gas, a TSX-listed energy company with a market cap of approximately $300 million. Prior to assuming leadership of Saturn in 2016, Mr. Jeffrey was the area finance manager for a Fortune 500 engineering consulting firm in Canada. Mr. Jeffrey was also a founder and CFO for Axiom Group, a geological and engineering consulting company that has drilled over 800 wells within Western Canada. Mr. Jeffrey is a graduate of the University of Saskatchewan with an MBA degree majoring in finance. Among other things, we discussed bootstrapping to 40,000 BOE a day, mid-life cycle assets, and perspectives of a junior E&P company in 2025. This podcast episode is powered by ATB Capital Markets. ATB Capital Markets provides financial solutions and strategic advisory services to help businesses thrive. With a track record of successful deal execution, ATB is a full-service investment dealer with a deep understanding and commitment to the industries it serves. Visit atbcapitalmarkets.com for more information. This podcast episode is brought to you by EPAC, the Explorers and Producers Association of Canada. Good morning, Mr. John Jeffrey. Thank you very much for doing this. I appreciate your time today.
Thanks for having me.
For the listener, you are the CEO of Saturn Oil Gas. But what is Saturn Oil Gas?
So Saturn Oil Gas today, we're about 41,000 barrels a day, primarily light oil. 3/4 of our assets are in Saskatchewan, so southern Saskatchewan, light oil, and I guess you'd call us a junior exploration company.
For the purposes of today's conversation, I thought we could structure it around you and how you got into energy and what you're doing now, and then some questions from an investor's perspective on Saturn, and we'll wrap up with some current events and whatnot, if that works for you.
Perfect.
So to start at the beginning, how did you get into energy and why?
So really, like my business partner and I, Justin Kaufman, got into this. Before this, we were at a consulting company that we had started called Axiom Exploration, but we were on the services side. So we did well site consulting, and that's kind of how we got introduced to oil and gas, is more through the service side. Saturn Minerals at the time was a junior coal company that was looking to get into oil and gas. So they approached us in late 16, kind of early 2017, and asked us to come over and take over management. So we did that. And at the time, Saturn, although being public, it really had no production, had no assets. So that was a unique way for us to get into it. It was easy because it was already public, but the downside that you see a lot of other management teams have is the advantage of founder shares. You know, lots of guys will start companies, issue themselves 1 penny shares and all this, whereas we have had to do things the harder way. So every share we've bought in the market, like our average cost is the same as our investors. So it's been a long road to get here, but every year the company just gets stronger for us.
Started out on the consulting side, and I think you got an MBA somewhere along the way?
Yeah, I did. Most of us, well, at the beginning, we were all University of Saskatchewan grads. And actually, when we started in, like, we were sharing an office with our friends at Axiom in Saskatoon. So we were in the only oil companies in Saskatoon, one of the few in Saskatchewan. But as we started to get bigger, one of the problems was you just couldn't find staff. You know, we needed some engineering support and we needed land support, and those resources just don't exist in Saskatoon. So eventually we had a satellite office in Calgary, and then before long, we just had to make the jump that we had more people in Calgary than we did in Saskatoon. But at the beginning, yeah, we were all U of S grads, and that made it fun for us.
Energy services consulting?
Consulting, yeah. So again, we were primarily, the guys I was partnered with were all geologists. So we did well siting and things like that. So that's really the strength behind our company, has always been geological focused. We've always treated rock a little differently. Like, to us, the resource isn't the capital, and it's the oil in the ground is the scarce commodity. So, you know, at the beginning, we would drill a little differently, would drill a little slower if needed. But, you know, in order to drill the best well we could to extract the most oil, that's always been our approach. And as a result, you've seen us consistently beat type curves. And when we got started in early 17, 18, you know, the first 3 wells we drilled, we're the top producing wells in the Viking. So that's always kind of been our focus. And I think that's led to our success here now.
And the consulting companies would hire you guys to take over well sites? How did that work?
Yeah. So, we sit wells for the company. So if you're drilling wells, you need geologists on site, and we just provide them those geologists, or we do some consulting work and drawing up different plays on their behalf.
So you got to meet a lot of people in the sector, and which eventually led to meeting the old Saturn management team?
That's right. We were watching all these companies at the time. It was Raging River, and it was Whitecap and Agata. We were watching all these companies in the Viking just drilling great wells. Of course, oil was sky high for a period there, and we were thinking, you charge guys out at $900 a day, and you'd make a little bit of profit on that. And then you'd see this well we helped them get online, and you're like, that thing just paid off in 5 months. We're in the wrong side of the business here. So that's when when the Saturn management came to us, that's when we decided, I think we're better off on that side.
Did you always want to have an E&P junior company and be an entrepreneur?
Yeah, I mean, I think it's always been a goal. I mean, growing up in Western Canada, oil and gas, right? Like that's the big industry. That's where all the successful companies are built. That's how you make your name, from construction to geology to services. Those are all good businesses and good industries. But oil and gas in Western Canada, that's the king of the hill for us. So when we got involved in Saturn at the time, it was largely German held, which was a little unique, but they were willing to put in a few $1 million to allow us to drill our first few wells. And that's really what took off for us. So anybody that's been following Saturn for a while, for the first 6 years, 7 years, everything came out in English and German, major German shareholder. Now they're probably 10% of the story, but we've had strong support from them this whole time. And again, just the way that we were able to kind of get started, drill 1 or 2 wells, go back to the market, use those results, raise a little more capital, find some debt financing. So it's just really been a piecemeal of putting this thing together one step at a time. And again, when we got started, oil was $60, $65. So you had to learn to be efficient. In fact, when we got started, we just didn't have any money. So on the weekends, we would go to sites, take sites apart, and we just do the work ourselves, because that's what we had to do to get started. That was required. When you don't have the capital, you get real creative.
So Saturn's been around since, I think, 2004 originally. Is that right?
Yeah, I think it was incorporated in 2002, public in 2004. And really, like I said, it was a Vancouver-based mining company, just junior mining from then. It wasn't until that we got involved again in late 16, early 17, did they actually kind of turn into a for-profit entity, really, or, a profitable entity.
So circa 2016 is when you took over as CEO.
Yep.
What did you see in the company that led you to the conclusion this was a good idea and a good opportunity?
Well, understanding oil and gas is technically difficult, but more than that, you need that capital. Like, it's just very capital intensive business. So to try and do it privately, some guys have had luck doing the friends and family and trying to raise enough money to get a well or 2 online. But really, to do this business at scale, you need access to public markets. You need debt, you need capital, and you need to raise as much as you can. So that's really what we've seen in Saturn. Like, although, again, they had no assets, no cash when we got involved, but they were public, they had a shareholder base. And so we just wanted to use that to our advantage. So when the opportunity came up, we said, okay, well, if there's ever an opportunity to get into oil and gas, ideally you'd want it to be through a public company. And here we have one, shareholders that we know, that trust us and that we want to do this with. Again, it's always come back to, like, why don't we start something new, and why don't we own it and control it? But for us, just to have that in front of us with a group that we had that mutual trust and respect for, we decided that was the best opportunity for us.
At the time, I think Saturn production was around 900 barrels of oil a day.
Yeah. So when we got started, obviously it was zero. So we took over with no cash or assets, but so we had started drilling in 2017. And then, so we were leading, we had hit a peak about 13 or 1400 barrels a day, kind of late 19 going into 20, taking our results, going back to market, raising a little more cash, bringing on some debt, just kind of rinse and repeating. And we were able to grow it, to a pretty material amount. Then obviously, what happened in 2020, especially when you're drilling in the Viking, it's a high decline field. It's high returns, minimum infrastructure. So Viking is a great place for juniors to start because you're not moving tens of thousands of barrels of water. You can drill, it's one of the most shallow, unconventional plays. So you can get good production on quick paybacks, low operating costs. So it's a great place to start, but high decline. So when you go into a period like we did in COVID and low oil prices where it didn't make sense to drill anymore, your production really trails off pretty quickly.
So in 2016, when you took over and you had some capital that you'd raised, how did you think about the risk? Did you have a drilling program, or were you just going to put it all on the first well and see what happened? How did that go?
So we raised enough for 2 wells. What was interesting was any of the land we'd ever bought to that stage, and actually this was true right up until 2021, we had never bought land with production or reserves. It was 100% greenfield because we didn't have the capital. So, what we did, and this is thanks to Justin and his team, is we just identified greenfield land that was overlooked for a number of reasons. They had developed such a strong geological model of the area that we knew there were certain sections of land that we could get cheap, and then, just trusted our ability to step in and drill it. Again, not needing that infrastructure support that you get in the Viking, that gave us an opportunity to drill. And again, those first 2 wells were the top 2 wells drilled in the Viking. And again, we're talking back then they were drilling 1,000 wells a year or more. So, we had some really good results. And again, we were just able to repeat that and gain shareholder trust over time.
So you drilled the first well and had immediate success.
Yeah. Yeah. It turned out to be a great well. And again, we followed that up with another well, and we just, we got lucky that if either one of those would have been a bust, or, it wouldn't, basically all the wells for the first 5 years were make and break. We had to make everyone hit. It was funny. I don't think the drilling company had ever seen anything like it. Those first few wells, the whole company would be in the well site with us. So, there'd be there's only 6 or 7 of us, but we're all, it'd be midnight. We're all in the geology shack watching these wells get drilled. What does this mean? What does that mean? Is that a good thing? And it was high stress because you had everything on the line.
You took the cash from the first well, put it in the second. That turned out pretty well, and you kept going.
That's right. Yep.
If they hadn't turned out well, what were you going to do?
Oh, well, that would have been a tougher conversation. This is the first time in the industry as management. First time, trying to get those shareholders to trust you and get stakeholders to trust you. So it was challenging because you just don't know people's opinion of you. The only thing they know about you is the last results. Can they drill a well? Can they operate? So for us, we have to earn it with every quarter, with every well, with everything we do.
Drilling dry holes is part of this industry, though. That's the way it is. It's the way it goes sometimes. But it worked out. Did you feel it was important to put your own money into the company to create a symmetry of risk with investors?
Yeah, it's funny. We were looking at some different companies, and I can say, we have, the management team and I, 95% of our net worth is in this thing. Every share we bought in the market alongside of our investors. So we couldn't be any more aligned than we were the first day. Again, it's always been all or nothing for us.
If I'm correct, you are the top inside owner right now?
I believe so, yeah. And again, over the last, I think a BMO report came out this morning that shows that we were one of the top management teams buying again over the last 90 days. And we're taking every opportunity we can to buy more shares.
Through the past few years, Saturn has grown through M&A?
Yeah, so we're 41,000 right now. For us, what happened through COVID is when we realized it was probably better to start buying production than it was to keep growing organically. COVID really spooked a lot of investors. And what you've seen is all the major banks in Canada quit supporting the industry. You've seen shareholders really turn their back on the industry as well. So we started looking at assets and just seeing how cheap they were going for. So we decided that this was probably the time to start looking to buy assets. So we've always been a fan of kind of bucking the trend. If everyone's running to the far side of the boat, don't join them. And so that we did our first deal in June of 2021. And then we've kind of done one major deal a year since then, kind of bringing us to where we're at today. But the pros and cons are the same thing. It's the reason that deals, we've never paid more than PDP on strip. We pay generally 2 times cash flow. And you're looking at assets that have historically traded at 3 or 4 times that amount. Now, the trade-off is, although you can get deals cheap, the reason you're getting them cheap is because there is very limited capital in the space. So that's what I think is missing from this is normally there'd be 10 other companies like ours bidding these assets up and selling them for a high amount. But really, when you look at Saskatchewan, specifically Saskatchewan, you're seeing a lot of those guys that started it. If you think, again, Raging, Vermilion, Whitecap, Crescent Point, Baytex, lots of these guys have either merged or they've shifted their focus to Northern Alberta or the States, or Vermilion is now focused on international gas. Not that they've lost focus there, but a lot of these deals now there's just not the junior space to pick them up. So creates an opportunity for guys like us. But the reason that opportunity exists is just because there's just a very difficult time raising capital and buying these assets. So it's kind of a double-edged sword. If there was lots of capital, these assets would be selling for 2 or 3 times as much. But now it's the opposite case right now. So we just believe the market right now is broken. Energy space in Canada is broken. The U.S. investors don't really seem to like it here. Between takeaway capacity, between the government concerns, they just don't want to put assets. They don't want to put capital to work in Canadian assets. Whereas on the other side of the border in northern Montana or North Dakota, northern Montana, they do same rock, same everything, but they'll pay twice as much for those assets than ours. So we're just trying to take advantage of what we believe to be a broken system.
This podcast episode is sponsored by Connate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Connate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info@connatewater.com or check out connatewater.com for more details. This podcast episode is brought to you by JSG Professional Services, Canada's trusted leader in pipeline construction management and inspection resources. JSG provides competent, qualified, and verified pipeline construction management and inspection resources, supporting Canada's largest pipeline companies from initial development through final execution. Whether your project involves new pipeline construction, integrity programs, maintenance, pump stations, compressor stations, or inline inspections, JSG has consistently delivered experienced professionals to Canada's energy industry. JSG proudly supports Canada's energy infrastructure with competent, qualified, and verified pipeline construction management and inspection resources. Visit jsginc.com for more information. You were able to get the support of the capital markets and whatnot. So how were you able to get the deals across? How did you get the money in the end?
So really interesting. Obviously, we were a younger management team. We needed someone to take a chance on us, and we did. We had Arun, who was actually on the show a couple months ago with you, and Ryan Mooney. Ryan Mooney has really been with us since the beginning, which is fantastic. He's put a lot of faith in us to execute, and I think we've continued to deliver on this last deal. Then we got National, we got Arun. Those guys, I think, see something in us and they like what we're able to execute on, and they've been able to put the weight of their institutions behind us, and that's allowing us to get these deals over the line. And again, those are 2 more stakeholders along with obviously our shareholders and our debt. These are guys that we want to prove right. We want to show that they made good investments in us, and every quarter when we release, these are the first guys we call shareholders, our bondholders, our bankers, and say, look, another quarter behind us, we did it again, and let's see what we can do next quarter.
You kind of mentioned already in terms of what you look for in buying undervalued assets, but the hallmark of good investing is paying less for something that is worth. So to what degree do you think you've underpaid for your assets through the last few years?
Well, so we have a pretty standard blueprint for what we look for. So we look for mid-life cycle assets where the infrastructure is already built out. So, for example, when Ridgeback Resources was primarily owned by Apollo, when they originally came for sale there in 2013, they had put out a news release saying that they were looking for $1 billion plus. That's what they thought that company was worth. And in normal times, they would have been right. I think $1 billion to $1.3 billion was probably the right value for that company. We ended up picking up for $525 million. We look for things that are proven. So every capital development program we've exceeded type curve, and that has been great. But we're not known to be exploration guys. We are buy and manage guys. So we like to buy assets and strip costs out of them. So if we can buy mid-life cycle assets where, we still have over 2,000 locations today, and we're able to then optimize these assets, strip costs out of them. Since we started with our first acquisition in 21, we've reduced our operating costs by 39%. We've been able to reduce our royalties, and we can use that infrastructure foothold that comes with these assets to lower cost and find little tuck-in acquisitions that we can feed into that. Like, we know who we are and we know who we're not. We're light oil. We're relatively shallow light oil. We're not heavy oil. We're not gas. We're not deep basin. We're never going to drill a $100 million pad. This is not what we do. But if we buy mid-life cycle light assets and strip, 10% of the cost out of them and find some additional plays along the way, that's a great value for us.
When you're running an M&A strategy, one of the main concerns is preserving your cost of capital. Through the last few years, how have you thought about that to make sure your advantages on the capital side are maintained?
Yeah, so that's a great question. And really what we look to do is, when we look at assets, we say, okay, what can we do and how do we structure this deal that in any oil price scenario, can we repay all of our debts? Can we still generate a return for shareholders? For example, when you look at us today, our PDP is north of $2 billion. Our PDP NAV after debt is almost $6 a share, which is almost 3 times where we're at today. But when we look to buy an asset, especially at these levels, we'll layer in relatively long-lasted hedges. So we look to hedge out 55 to 60% for the next 12 months, and then another 6 to 9 months kind of on top of that at about a quarter of the production. And the thesis has always been, if oil takes a 25% downturn, can we still satisfy the debt? Can we, if COVID 2.0 happens, are we okay? We always joke, like, people talk about debt, and we said, perfect, well, we have this anti-debt over here in the form of a hedge. Debt's not a problem if oil's always going up. Debt's a problem if oil falls. And that's what we protect against. So we protect against foreign exchange, the differential, and the commodity. So we really try and take all the risk we can off the table because we understand that, our leverage right now is about 1.4, 1.5. Historically, companies used to run at, 3 plus times. We think 1.5 is very reasonable. We have line of sight in the next 2 years to get it below 1. And in the meantime, we're just going to have a bigger hedge book on to ensure that any kind of volatility we are well protected against.
So the critical investor would say price volatility and debt are very bad. That is not what you want. And Saturn's debt, while it isn't crazy, is higher than some companies. I guess your answer to that would be the hedge book and the long perspective on things?
Yeah, which is well protected against any fluctuation in differential, in commodities. If oil goes to zero tomorrow, we can repay 100% of our debt. We can meet all of our obligations. So that's really, what we set out to do. Where we get criticized, if you are, a massive bull and you said, well, oil is going to go to $120. Yeah, the argument could be, we're probably not the name for you. I agree. If you think oil is going to drop to $40 a barrel, well, then you don't want to own oil at all. We're of the mindset that we think it's going to be range bound for the next 12 to 18 months. And so that's how we design our collars that way. We design everything to to maximize the profit while minimizing the risk kind of in that pricing scenario. So again, you lose a couple of guys on both sides. So it's a specific investor we're looking for. But if we can find one and they agree with our outlook on oil, then I think we've set up a great company for them.
Another critical investor might say through the M&A strategy, the share count has gone up, which I don't like. How would you respond to that?
So every time we look at a deal, because I've had this conversation with a few investors, and it's always been kind of the same. I always start with the same thing. I said, do we agree a deal cannot be both accretive and dilutive? Okay, if we can agree with that, here's why, any particular deal is accretive. If you look at per share and we look at debt reduction. So that's how we present it. And sure, your share count goes up, but if we agree that after that, it is in fact still accretive, then that's what we use. So last summer we entered into bond debt financing. They come due in 5 years. So we amortize 10% a year over 5 years, or 50%. And so what we've done is we've kind of set those goalposts hard in the ground and said that is our debt target. And everything we do between here and there, if it doesn't serve to satisfy that goal, then we don't pursue it. So does it reduce net debt or total debt? Does it increase your production per share? Without moving those goalposts, everything we do has to achieve that. So, what we've kind of said, Lucy, is half of our cash flow goes towards repaying debt and half goes towards growing our production per share, either through tuck-in acquisitions or by retiring shares.
And if I'm correct, a lot of the Saturn debt is term debt. What is term debt and how is that advantageous to the company?
Yeah. So again, they're all bonds. They amortize at 10% a year. So it can't be called on us. So even if, again, COVID happens, the worst happens, it's not like any traditional bank financing where they can get worried and call that debt. That can't happen in this case. We do carry those hedges to assure our bondholders that they are safe. Again, the advantages are that we do have forced amort in there because we want to illustrate that, we are focused on debt reduction. However, again, at 10% a year, and because of our massive free cash flow numbers, we're not concerned about servicing that debt, and that is backstop. So that's kind of the advantage. And again, when you take 2025, for example, we're looking to give about $25 million back to shareholders through buybacks. In addition, we're retiring over $90 million of debt. So the way we see it, we're giving about $120 million back to the shareholders on the market cap right now at $360 million. So, it's over a third of the value we're giving back to shareholders just this month or just this year alone.
There's a lot of cheap assets out there, but do you ever think about just standing still for a little while and returning capital to shareholders for a while?
Yeah. So, we've looked at over 120 asset packages, and I think we've executed on 6 of them. It's kind of my thoughts that I think the market will eventually correct itself. If in 6 months' time we get an election in Canada, the tariff talk goes away, there's some stability, and we get some more pipeline egress, I think you're going to start seeing more and more U.S. investors look north to cheap assets. So we do, obviously we pass on 10 times more assets than we acquire, and we are always looking for that, just the perfect fit for us. But I will say, I do think we are living in kind of a unique time right now. I don't know if it's 6 months or 12 or 18 months where assets go back to kind of normalized pricing, which would be 2 or 3 times. So although we are particular, we are trying to take advantage of what we believe is currently a broken market as well. So, but for right now, we are doing that. We are sitting still. We are starting to return more cash to shareholders, and that's been part of the plan, through the last half of 24 and for 25.
Saturn's also doing some drilling, like you mentioned. One technique being the extended reach horizontal drilling technology in the Viking. What makes this approach stand out? And are there any other drilling techniques or innovations you're working on?
Yeah, there's a couple of really exciting ones we've done. So in the Cardium in particular, if you look at, there's probably 6,000 wells drilled in the Cardium in Canada, and we've drilled the longest one ever at just about 3 miles long. Again, what happens if take a $70 price tag? If you take a 1 mile Cardium, you're probably 40% IRR. If you can extend it to 2 miles, you jump to about that 60%, but 3 miles, you get closer to 80%. So it's taking a play that hasn't really been sexy for a while, and we're using a new technique. We have a proprietary completion technique that we developed in-house that allows us to frack those wells. We're using some new technology that allows us to steer and drill those wells. You're taking, 40% rate of return, which is a good rate of return, but now all of a sudden it's jumping to 80, and it is opening up more excitement into these places. So we've drilled our first one last year. We brought it online. It's way ahead of type curve. Same with the Viking. If you can extend the reach, your economics improve. But really one of the more exciting plays you're seeing is that multilateral you're seeing in Southeast Saskatchewan. So they came out with a new royalty holiday in Saskatchewan, which is fantastic. But even without that, this is a very exciting play. You're seeing Varen do it, you're seeing Cache Island do it, and you're seeing us do it in the Bakken. And those have been hugely successful for us. In fact, really starting from this year forward, we'll have a full-time rig that just drills those. But you're seeing us do the same thing in the Spearfish in Southeast too. First company to ever do it. And again, taking a technique that was really innovated and created for the Clearwater, bring it into Saskatchewan. It was done a little bit in the heavy oil fields of, west central Saskatchewan, but applying that to new fields, it's been a game changer for us.
Sometimes the long wells are expensive. How do you balance that with making sure you're making money?
When you take into account sinking your original vertical section down, these wells do get cheaper as you can extend the reach of that. You're showing more reservoir to it. So we find that the IRR increases as you extend them. So for us, it's been a trade-off worth doing.
That's a lot of operations questions. We could probably do another hour on that, but maybe we'll move into the perspective of being a junior oil company nowadays in Alberta, and a few questions on that, if that's okay.
That sounds great.
Although it's a good time to be a junior buying assets in Alberta, there are still hurdles and headwinds. It's not easy. From your perspective, how can Alberta and Canada make it easier for junior E&P companies and entrepreneurs to succeed?
I mean, the barriers to entry are real in the sense it's capital. You need to outlay an enormous amount of capital. To be competitive in land sales is difficult, and then to to get drill rigs, to get everything together before you can even show a barrel of production is difficult. One of the things we were thinking about was, is there a way, even if you started a company today and you wanted to maybe buy and recomplete some wells in the Orphan Well Fund? We haven't looked in this so much, but as I understand it, you would have to then buy those wells. And I think even if you wanted to buy those wells, you'd have to post a bond. They should make that easier. If junior companies can look to the Orphan Well Fund, get those licenses transferred to them for next to nothing, because worst case, they're going to end up right back where they were. If you can get these guys, let them try some new techniques, let them try some recompletion, let them try a couple of things. And if only 10% of them work, well, that is 10% less wells that are going to live with the taxpayers. And maybe that's enough to get them some production and cash flow, then they can start to grow organically. Same, in the Viking, we did it 100% organically. In the Viking, you can do that. Lots of these bigger plays in Alberta, you just can't get away with buying greenfield, not having the infrastructure. So if there's a way that we can have the juniors be shopping in those Orphan Well funds and let them try a few different things, I think it would help. Again, just getting on that first rung as a junior oil company is really going to be important. And again, for the next guy, they've got to prove they can do it. They can build a bit of a reputation, get a few barrels online, and then start to expand from there. I think that would make a big difference.
This podcast episode is powered by Broadbill Energy, the local midstream company that puts producers first. Broadbill Energy does things differently and doesn't just move energy. They are moving the industry forward. While others take a cut, Broadbill shares profits back with their customers, because when Broadbill customers win, so does Broadbill. With a producer-focused approach, Broadbill specializes in the gathering, processing, and transportation of oil and gas, ensuring safety, reliability, and maximum value for the people who actually produce the energy. If you're tired of the same old midstream model and want a partner that works for you, it's time to talk to Broadbill. Visit broadbillenergy.com to learn more. This episode is brought to you by Astro Oilfield Rentals. Planning your next drilling or completion site, or budgeting for an upcoming construction project? Astro has your remote communications and accommodations needs covered. With over 25 years of experience serving Western Canada, Astro continues to expand, innovate, and deliver the best value for your investment. Astro offers a full range of communication solutions, including cell towers, radios, and internet services. Astro's lineup features well site trailers, sleepers, full gym units, medic centers, and custom-built command centers, helping you stay connected and comfortable in even the most remote locations. Visit astrorentals.ca for virtual tours and more information. Have you faced large headwinds regulatory-wise, or how have you thought about that as a junior company in Alberta nowadays?
With the Ridgeback acquisition in 2013, we got into Alberta, so we were already relatively decent size. That got us to 20,000 barrels a day. So we had the cash flow, and we were lucky enough that we could deal with the hurdles. Saskatchewan was a little more difficult when we were first starting and quite junior. Everything from road deposits, the different RMs would want different amounts of money, and it had to be paid in cash. And you weren't sure how you were going to get it back. And same when we first got started and did our first acquisition. Originally, the government wanted $100 million as a deposit. And it was a non-starter for us. And so we went back and forth. Finally, we landed on 20. So we were able to raise that through great difficulty. But now we've got that back. We've cleaned up all of our wells. In fact, we're top quartile of the cleanest companies now. But at the time, that was almost enough to kill the deal and to really stop us dead in our tracks. So just to introduce a little more flexibility for juniors, because it's heavily regulated, and it should be. But you can't prevent those juniors from starting up.
Is it getting easier to start up, say, than from 2020?
I don't think so. And the market would tell you no, because you're not seeing a bunch of startups. In fact, you're seeing lots of these companies just sell. A lot of these companies are just merging and selling, and I'm not seeing the next round of companies coming in behind them. Again, we talked about a few of the names earlier. Even Botus and those guys, the Spartan Deltas, they've had a great track record. If they were to ever sell, I bet you they'd start again, because they've earned that reputation, that following. But for the next guy to start up, a green company with a green team, it's difficult. I think you're seeing a couple of the privates with a little bit of private equity money. I know Hawthorne is one. I think Cornelian backs them. So there's a little bit of money starting to trickle in. But right now, especially on the public side, companies aren't getting rewarded for it. And I'm not seeing a whole lot of companies doing much.
One way to think about it might be is you just got to survive. Eventually things will pick up again. Do you think about it that way?
Yeah. We haven't really had our time in the sun since we've started. You look back at inflation adjusted prices back in 2008 and 2012 and 13, oil was $100 to $120 a barrel, and you could drill anything and make money there. So, but again, we're making this year at $70 oil, we'll do close to 700 million EBITDA. So you're still talking significant numbers, but if you start looking at $100, $120 a barrel prices, you start talking about making $1 billion plus of profit every year for a junior company with an enterprise value of $1 billion too. It starts getting pretty silly when you see prices like that. And we've seen it happen in the past. And again, the sweet spot for us, 70 to 80, 85, that's really the sweet spot. It's not hurting consumers. You can grow a good business and everything. Everyone's able to profit.
Another way some companies look at it is if you build a good house, so to speak, that eventually somebody will want to come along and buy it, reduce the debt, not much ARO, good production. Do you ever think about it that way? Eventually someone will come knocking?
We try and make a desirable company that somebody wants to buy every day in the stock market. Whether you want to buy $20 of our shares, if you want to buy the whole company, it's my job to increase that value and make us look as attractive as possible. So that's what we try and do. We are reducing our debt. We are reducing our ARO. You try and make it appealing for everyone to buy. We didn't design this thing just to be bought out by another company. Lots of people have always said, well, if you sell now, you could restart and you can give yourself the founder shares and you could own more of the company. And I always put it back to that scene in Shawshank Redemption. Like, it feels like we just crawled through that mile of sewer. And, if you can pop up on the other side and somebody said, well, that's great. You want to do it again? No. Like, starting junior companies these days is so difficult, and raising money is difficult, and everything was so hard to get to that now we're just starting to get to the point where it's fun and you can deploy money into waterflood projects and these other projects, and you can see that return. And it's not the high stress make or break of every well, every decision, every nipple that goes out. So we're starting to have a great time, but listen, it's not my company. We work for the benefit of the shareholders. And if an offer comes along and shareholders want to take it, then we support that. So really, that's just the understanding that this is no more mine than it is any other shareholder. Mm-hmm. We're just a steward of their capital.
To get a sense of how hard it's been, when you guys were trying to raise money, was there lots of no's? What was that experience like?
Oh yeah. I mean, every raise we've done has been more difficult than last. In fact, all the major deals, there's 2 or 3 points during it where y'all look at each other and say, yeah, for sure, this deal's dead. Like, there's nothing we can do. We lost a shareholder, or the bank's pulling out, or there's some major thing, and all of a sudden, it does get back on track and you do manage to pull it together. But it's just difficult because, you have so many great names that are trading low, that are lower risk. When you're talking to some of these major funds and they said, sure, those are good assets and you guys are trading cheap. But, look at some of these bigger names that, yeah, they're trading a little more expensive, but still historically low. Like, I'll go buy CNRL, I'll go buy Tourmaline. These are great proven names. Yeah, they're more expensive than you, but cheaper than they have been in history. So, and a lot of Canadian institutions, again, are hesitant on oil and gas. And again, the U.S. investors haven't looked this way a whole lot. Now, we were really lucky. Our 2 kind of cornerstone shareholders now are GMT Capital and Libra. So Tom and Ranjan, who have been huge supporters. In fact, I think they're 2 of the biggest individual investors in Calgary. Both kind of those, they managed family offices, managed anywhere from 3 to 5 billion US, primarily invested in energy. Yeah, and they've been big supporters of us. Collectively, they own about 42% of Saturn, and they've got behind what we're doing. And that's one thing I point to is, although we are a newer team, those guys are self-made guys. They're well-known commodities. They're the biggest shareholder than half the names in Calgary. And they put a lot of faith and a lot of capital behind us. And we're hoping that we can trade on their name a little bit and get our shareholders to see what they see.
What's the biggest opportunity for Saturn, and on the flip side, biggest risk right now?
Biggest opportunity is just continuing to do exactly what we have. We're not an exploration company, so we're not sitting here saying, listen, if this new field hits, then we're really going to take off. We don't have that. We're going to deploy 300 million this year. Our wells are relatively scattered. So, we are drilling within 150 meters of offsetting wells. So there's not a lot of risk there. Our operations team is fantastic. We've been able to reduce costs quarter over quarter. So I think we can execute there. The risk is how do you get that incremental buyer? How do we get one additional person to see that, we have a 40% free cash flow yield? Does that make sense? Will somebody come down cap enough to care about a company of our size? And that's the risk, is just getting people's attention. I think most of the downside in oil is priced in. I hope it is. I think we're at the low end of most people's range. Listen, Goldman Sachs today, again, their range is 65 to 80. We're at the low side of that. So I think we've done a great job in protecting the downside. It's not that lower oil price hurts us. It's lower oil price hurts people's desire to invest and look for deals in oil and gas. So if we can get a bit of a sustained rally, yeah, the price helps and the cash flow helps. But just getting those eyes, getting people excited about energy again. And then once they start looking at CNRL and then Tourmaline, and then they start coming down stack to find better and better deals, I think that's the exciting part for us.
The change in federal leadership, or at least moderation in perspective from Ottawa, may also affect the psychology on the energy industry going forward?
It has to. Trudeau spooked a lot of investors. They were pretty clear that Bill C-69, they didn't want Canada to export more oil, at least not through tankers. So that really left us with only one option. So I think there's been a lot of concerns about egress. We do need another pipeline. Keystone XL should probably be built. Will Energy East happen? I doubt it. I just don't think you're going to be able to get all those different parties on side. But, can we get egress through northern BC? I think so. I think Churchill's an obvious one. I think more egress into the States makes sense as well. We have a lot of demand for our product around the world. And I think we just need to do a better job as a country in delivering it.
As a junior company, have you had problems with egress?
We haven't. Southeast Saskatchewan is the best place to operate. That when we sell through Cromer, that line has almost never been apportioned. Because again, when you look at the production in Southeast Saskatchewan, it's down 40% from its peak. The market lines are there. Our infrastructure is there. The takeaway capacity is there. So most of our fields, Cardium, we've seen a little bit time to time, not near as much as each in Northern Alberta. But yeah, Southeast Saskatchewan has been fantastic for them.
It's easy to throw rocks at someone who's taking the risk, putting their reputation on the line, starting a company, being an entrepreneur, especially anonymous. Easy to throw rocks as an anonymous person. Do you think it's recognized enough, the entrepreneurial risk that people take nowadays, especially in the junior markets and energy?
No, not at all. I mean, it's just armchair warriors, right? It's easy to watch football on Sunday and yell at the quarterback for not doing the right things, and you think the coach is an idiot and everything. So it's really easy to throw stones when you're not doing it. Everyone has 20/20 hindsight. And for us, we love what we're doing. I love the guys we work with. We love the culture we build. We just run things a little differently. We operate a little differently. We don't look like a lot of other companies, and we take pride in that. So I think anyone from the outside that just can't see what you go through, that can't see the hard work that our team puts in, walk around the development floor at 6:37 at night on a Friday and watch the guys putting in hours and watch, the joy when we're bringing wells on 20-30% above type curve, thanks to the hard work of some of these guys in reducing operating costs and the great work that they've been able to do in growing the reserves and the cash flow. You take so much pride in that, and the team takes so much pride in that. But then, you see some guy online, unless you're there, unless you're doing it, unless you're in the industry, I just don't think you appreciate the work that goes into it.
Yeah, exactly. If you had to boil down Saturn Oil and Gas to a single idea for someone hearing it for the first time, what would it be?
Oh, that's an interesting question. Really, you have to get to know us. You have to get to know the company. And the reason I say that is we don't fit into a traditional box. When you look at our cash flow, you look at our reserves, we look a lot different than our peers because we operate differently. We're almost 90% liquids. Most oil-weighted peers are 70% liquids, 75% liquids. So when you look at things like capital efficiency, you can say, okay, well, hold on. Saturn is 27, 28,000 a BOE, and some of these other guys are 2021. Sure, but our netback's $45 a barrel. And, you kind of have to look at what's the cash flow, what's the track record. So a track record of consistently beating on production, on consistently reducing operating costs. What's the risk, and what are we doing well? And I think just continue to perform quarter over quarter is what we're doing now, doing well. And I think as we see the risk come down, or the perceived risk of debt and these other things, I think once that starts to go away, I think people are getting excited about what we built here. Look at the results. This year alone, we're looking to return between debt repayments of 90 million and a share buyback. Yeah, we're going to return 30% back to shareholders. And that's if we execute to the bottom end of the range. We've always surprised to the upside. We always will, I hope. And when you look at the work that the team's been able to do, that's what I take pride in. And then that's where I think our investors, the reason that Tom and Ranjan at GMT and Libra, I think, trust the team so much is that we're able to bring them in the office. They're able to meet the guys. They're able to see the team. They're able to see the work we do. They can look inside and see like, yeah, these guys, these are real guys. They know what they're doing and they're doing great work. And it's hard to show new investors that in a news release or in a 45-minute call. But if you can get into the business and look what the guys are doing, it's pretty exciting.
I really appreciate your time today.
Thank you.
We can end the formal conversation there.
Perfect.
And this is anything else you want to add?
No, I think that's it. Thanks for your time today. It's been great.
Hello, listeners out there. Thanks for checking out the podcast. Hopefully the episode provided some insights. If you enjoyed the show, check out trose.ca where more episodes are yet to come. You can also subscribe to the podcast where your token of support is much appreciated. Until next time, happy coffee drinking.